It was a day of reckoning for Bitcoin in the halls of corporate America. On December 10th, 2024, Microsoft shareholders gathered for their annual meeting, and the agenda held a contentious item. Should Microsoft add Bitcoin to its balance sheet? The proposal, put forth by the National Center for Public Policy Research, sought to push the tech giant into the world of cryptocurrency. However, not everyone was on board. The debate reflected the growing pains of a financial world grappling with the rise of digital assets. The NCPPR, known for its pro-free market stance, argued that Bitcoin was not just an investment, but a strategic asset. They believed it could provide a hedge against inflation and diversify Microsoft's portfolio. The proposal suggested allocating a portion of the company's profits between 1% and 5% to purchase Bitcoin. They pointed to the increasing adoption of Bitcoin by institutions and corporations, including BlackRock, as a sign of its growing legitimacy. Shareholders, entrusted with the future of the company, found themselves at a crossroads. On one hand, there was the allure of potential profits and the fear of missing out on the next big technological wave. On the other hand, concerns lingered about Bitcoin's volatility and its place in a traditionally conservative corporate balance sheet. The room was divided, mirroring the larger debate about the role of cryptocurrency in the global financial system. The vote would have significant implications not just for Microsoft, but for how other corporations viewed Bitcoin. A decision in favor of Bitcoin could have sparked a domino effect, encouraging other companies to follow suit. A rejection, however, could cast a shadow of doubt on the viability of cryptocurrency as a mainstream corporate asset. The stakes were high, and the eyes of the financial world were on Microsoft. The NCPPR, not known for mincing words, came prepared to make their case. In a pre-recorded video presented at the meeting, they opened with a bold statement: Microsoft can't afford to miss the next technology wave, and Bitcoin is that wave. The video, designed to be persuasive, featured charts and figures illustrating the potential value of holding Bitcoin. The NCPPR emphasized that Microsoft had a duty to its shareholders to explore all avenues for profit and value creation. They argued that Bitcoin, with its limited supply and growing demand, had the potential to generate significant returns. They pointed to the success of companies like MicroStrategy, which had invested heavily in Bitcoin, as evidence of this potential. They further argued that holding Bitcoin could act as a hedge against inflation. With traditional currencies facing devaluation, Bitcoin, they claimed, offered a more stable alternative. They presented data showing the erosion of purchasing power due to inflation, contrasting it with Bitcoin's performance over time. The presentation also touched upon the increasing mainstream acceptance of Bitcoin. They highlighted the growing number of businesses accepting Bitcoin as payment and the emergence of Bitcoin ETFs. They argued that Microsoft, as a technology leader, had an opportunity to be at the forefront of this financial revolution. Microsoft's board of directors, however, was not convinced. In a statement released prior to the meeting, they recommended that shareholders vote against the proposal. Their main point of contention: Bitcoin's volatility. They argued that the unpredictable swings in Bitcoin's price posed an unacceptable risk to the company's financial stability. They emphasized that Microsoft needed to maintain a predictable and stable financial position to operate effectively. This included ensuring liquidity for day-to-day operations, investing in research and development, and making strategic acquisitions. Bitcoin, with its price fluctuations, simply could not provide that level of certainty, they said. The board also pushed back against the comparison to MicroStrategy. While acknowledging that both companies operated in the technology sector, they argued that their business models were fundamentally different. MicroStrategy, they pointed out, had a significantly smaller asset base and a different risk tolerance. They maintained that Microsoft already had robust systems in place to manage its finances and explore investment opportunities. They argued that these existing processes were sufficient to ensure the long-term financial health of the company without taking on the unnecessary risk of Bitcoin. A Section 4 shareholders side with stability, rejecting Bitcoin's allure. In the end, the majority of Microsoft shareholders sided with the board. The proposal to add Bitcoin to the company's balance sheet was rejected. The decision reflected a prevailing sentiment among investors. While the potential rewards of Bitcoin were enticing, the risks were deemed too great. The vote highlighted a key challenge for Bitcoin's widespread adoption. While its proponents touted its potential as a store of value and a hedge against inflation, its volatility remained a major stumbling block. For many investors, particularly those responsible for managing large sums of capital, that volatility was simply too much to stomach. The rejection, however, did not diminish the significance of the event. It brought the debate about Bitcoin's role in corporate finance to the forefront. It forced investors and executives to grapple with the implications of this emerging asset class, and it highlighted the tension between traditional approaches to finance and the disruptive potential of cryptocurrency. While Bitcoin may not have found a home on Microsoft's balance sheet that day, the debate was far from over. The vote served as a reminder that the financial world was in a state of flux, and the future role of cryptocurrencies remained to be written. Section 5. A sign of the times, traditional finance versus the crypto wave. The Microsoft shareholder vote was not an isolated incident. It was a microcosm of a larger trend playing out across the financial landscape. Traditional financial institutions and corporations were increasingly being confronted with the rise of cryptocurrencies. Bitcoin, with its decentralized nature and potential to disrupt existing financial systems, presented both a challenge and an opportunity. On one hand, cryptocurrencies like Bitcoin offered the possibility of faster, cheaper, and more transparent transactions. They had the potential to streamline cross-border payments, reduce the need for intermediaries, and empower individuals through financial inclusion. This potential had not gone unnoticed by tech giants and venture capitalists, who were pouring billions into the development of blockchain technology and crypto-related projects. On the other hand, the decentralized and unregulated nature of cryptocurrencies also raised concerns. Governments and regulatory bodies around the world were grappling with how to oversee this new asset class, concerned about its potential use in illicit activities and its impact on financial stability. This regulatory uncertainty made some investors wary of diving headfirst into the crypto market. The Microsoft shareholder vote illustrated this tension perfectly. It demonstrated the allure of Bitcoin's potential and the apprehension surrounding its volatility. It showed that while the crypto wave was undeniably gaining momentum, it still had to overcome significant hurdles to achieve mainstream adoption. The story of Bitcoin and its integration into the traditional financial system is still being written. Whether it becomes a widely accepted asset class or remains on the fringes remains to be seen. However, one thing is certain. The debate sparked by the Microsoft shareholder vote is a sign of the changing times and the challenges and opportunities that lie ahead for the future of finance.